Hello and welcome. My name is Joe O'Mara. I'm the Head of Aviation Finance with KPMG. And on behalf of KPMG and Airline Economics, I'm delighted to be joined by Mike Inglese. Mike is the CEO of Aircastle. He's joining us for the purpose of our Aviation Leaders Report for 2025. And we're recording this in late November. Mike, thanks as always for joining us. Before we get into the meat of the conversation, do you want to tell our watchers a little bit about Aircastle?
Sure. Thanks, Joe, and thanks for having me. Aircastle is a leading secondary market player in the aircraft leasing space. We own 260-odd aircraft and manage a handful for a joint venture on lease to customers in 77 lessees in 45 countries around the world. About $8 billion in total assets, and we're one of the few investment-grade rated lessors in the aviation finance space. And we are celebrating our 20th anniversary this fall from our founding back in 2004 by Fortress Investment Group.
Well, congratulations on that milestone, Mike. And maybe given that depth and breadth of activity you'd see across the market, do you want to start off talking about what the demand environment was like so far this year? And just, are we seeing any kind of interesting trends from a geographic perspective in there?
So the demand environment remains very strong for existing narrow-body aircraft and in addition, wide-body aircraft, which is not a big focus in our portfolio now. We've seen a tremendous amount of interest in extensions, largely driven by OEM production delays, both related to Boeing's issues, its strike, its MAX production issues, as well as the GTF issues at Pratt & Whitney in the context of their GTF engine in all over the world. And it's affecting many of our customers. And so customers who are either dealing with grounded aircraft from GTF issues and or delays of delivery of new aircraft from either manufacturer, keeping hold of existing capacity and expanding and extending those existing leases on prior technology has certainly been a trend that's been more prevalent in the last couple of years in the industry.
So relatively strong demand environment. And are you seeing any particularly heightened areas across the globe where demand is incoming, or you think it's just across the board?
I'd say it's pretty across the board. As we've seen the rebound from COVID, clearly regionally, most areas are above pre-COVID levels now in 2024, with the exception of Asia Pac, which is just about getting back there. So we've seen a little bit of a lag there, particularly with respect to outbound Chinese traffic. But demand, I'd say, is broad-based, as we've seen a limited number of assets come out of existing lessees and look for new homes. There have been multiple parties interested in taking that lift. And that, again, is broad-based geographically around the whole world.
And if you look, and we might come to the supply issue in a moment, if we think about it in terms of maybe the challenges that your customers are facing, we've obviously come through COVID, the biggest challenge maybe we've ever had. But when you look at maybe the BAU, the business as usual challenges they have around, whether that's from a labor cost perspective, whether that's in relation to fuel challenges or risks of financial depressions in various parts of the world, do you think we're at a heightened state in that versus maybe where we were in a pre-COVID period, or is it broadly where it kind of sits at a medium type level?
It's probably a little more heightened. I think although we've seen demand come back, the issues airline customers are facing are the natural ones, as they've seen the resurgence in demand, they've seen their profits soar. Now, of course, labor unions want some of that. Oil prices are up, but not materially from where they've been. And of course, the supply chain issues create not just time and delay challenges for airlines, it's created cost pressures as well. So airline profitability across many carriers has been under pressure in the context of what they were enjoying, maybe a year ago, or in some cases on a pre-COVID basis.
And maybe moving on to that supply side challenge that you referenced, we clearly have OEM delays, engine troubles that you've mentioned. Can you talk about the impact that's having on Aircastle's business, as you said, predominantly operating in the secondary market? So as you think about that supply side constraint that's there at the moment, how's that feeding into your day-to-day business and your business planning?
So I think the biggest impact for us of the delays is sort of a shift in some of the competition of seeking new investments in existing aircraft in the secondary market. Some of the bigger order book players who were not getting the deliveries, or in the case of from their perspective, investing dollars at the rate that they would like to. They were out in the market looking for additional investment opportunities, perhaps in spaces which we typically wouldn't find them as a competitor in terms of finding new investment opportunities. So that's made investing a bit more challenging. It requires us to look at a lot more potential transactions and find the right fit for what we're looking for to expand our customer base, what we're looking for from a risk-adjusted return profile. So you got to do a lot more work to get to the same sort of investment level outcome in terms of widening your original funnel and then finding deals that actually meet the parameters that we're interested in investing at.
Yeah, I might come on to the trading environment in a second to get your perspectives on that, but keeping with the supply side and maybe moving broader than Aircastle, just how big a problem do you think the supply side challenge is for the sector, and just how do you see it uncorking over the medium term?
Look, it's a challenge. It's sort of many things in this industry are double-edged swords. What's good from one perspective may not be so good from another perspective. Clearly, the supply challenges have led to the non-production of over 2,000 narrow bodies in the last 5 years that you're never really going to catch up with. So that sort of tightness of supply creates a demand environment that has been good for lease rates, that has been good for asset values. But as I said, it also creates challenges of trying to grow our own book and find suitable investments in the context of what that means. How long is it going to take? I think it's going to take pretty much the balance of this decade before all of this really gets worked through and the GTF issues get solved in a way that produces a reliability of an engine that the customers were used to with prior technology. All the new tech fuel savings are great, but when it requires much higher maintenance costs and much less reliability or time on wing, that's not an equation that works for an airline customer.
And I know you're not predominantly, you're not order book focused, but do you think as this hopefully rights itself over the coming years, do you think we'll see an evolution of how OEMs interact with lessors?
I think we've seen that already in the kind of boom years of post-financial crisis to giant order books for the OEMs. Many of those order books were from newer lessors, particularly from Asia. And the balance of the order book was not, I think, what the OEMs really wanted. To me, that led to many sort of less creditworthy airlines getting access to new planes at ridiculously low rates from people who were just getting in this business. I think the OEMs are going to want to manage the lessor size of their order book as they go forward to sort of counteract some of that dynamic in the marketplace.
And maybe you referenced lease rates. If I can bring you back to that point, lease rates, two of the primary factors is obviously the interest rate and the demand environment. Both would seem to push towards an increased lease rate. Can you talk to us what you've seen from a lease rate perspective spike? And do you think that's something that's a sticky spike, even if we get into a world where interest rates are starting to decrease ever so slightly?
I think, clearly interest rates post-COVID went up at a much faster pace than lease rates did. I think lease rates have caught up. And I think are at levels more appropriate for where the interest rate environment has gotten to. Central banks have started cutting rates. The actual rates in the market are not necessarily reflecting that as a result of some of the geopolitical risks in the world, and of course the U.S. election outcome. So where rates really settle, it remains to be seen. But it feels like lease rates have gotten to more rational levels, and it feels like maybe we're sort of peaking there, but I don't really see any signs of lease rates, starting to taper off just because if central banks have made the first few cuts on an interest rate basis.
And in terms of lease extensions, which you said at the start, you obviously have earlier airline engagement. Can you maybe frame that for me in the context of what you're seeing now versus maybe what you were seeing 2019 as maybe a base case piece, and the value or importance that you'd place on extending rather than taking that aircraft back? Because obviously the dollar number is going to drive a huge amount, but how important it is that, geez, I can put this extension, I know my customer, I have less reconfiguration expenses. Can you just talk to me about that dynamic?
Yes, so you touched on kind of the main points. Every time you're looking at a lease expiry, you're asking yourself, what's the best outcome for this asset? Can I take it to a new customer? What are all the costs involved in that? The transition costs, the reconfiguration costs. What does that new rent mean? What are the new maintenance conditions and terms in that lease? And what does that all add up to on an NPV basis versus leaving it with an existing lessee? The operational aspects of leaving it where it is are clearly much easier in the current world, and given the supply chain constraints, not just with the OEMs, but with the MROs, and actually getting engines through a shop, getting new seats, getting all the things you need to do for a transition typically makes that a higher risk element to think about in the context of taking a plane to a new lessee. And then, of course, the third option is always, maybe this plane's old enough that I'm going to part it out, or I'm going to sell it, or dispose of it, in some fashion. So you're always balancing what's the math and what's the operational risks and what's the environment I'm looking at what I'm expecting at the end of whatever that new lease term will be, whether it's an extension or whether it's a placement with a new customer.
And in terms then of that engagement around extensions, just how early are airlines knocking on your door now?
Clearly earlier than they were 6 years ago. And again, it depends on each airline and their own situation, and how much, in the case of GTF issues they're dealing with, how long they think those will take to resolve themselves. What's the balance of incoming new assets for them versus what they expected to retire maybe a few years ago versus what their updated view on what do I need for capacity, and how much of what I think I'm taking is replacement versus growth capacity, given my circumstances as an airline.
Yeah, and maybe moving on then to the trading environment, as you mentioned, predominantly operating in the secondary space, and you guys buy and sell a lot of assets, always have, and I'm sure will continue to do so. As you look at this year, or your expectations around 24, are you buying more than you did last year? Are you selling more than you did last year?
So I think the answer to both questions on both sides is yes. I'd say a little bit more on the buy side, and probably a fair bit more on the sell side. And it's really, again, a balance for us of looking at our portfolio, looking at our customer exposures, and thinking about where might I want to lighten some customer exposure and free up capacity to do perhaps some new deals, and can I sell an asset at what I think is a buyer's yield that's lower than I think I can redeploy that capital. So that's all the sort of calculus in the mix. Trading levels overall in the market this year, I think, are still going to be substantially below where they were pre-COVID. But I'd say, last year was a big comeback year from kind of the COVID hangover from an overall trading volume perspective. This year, I think, is going to be maybe 10% higher, but we're still probably a third or more below the volume of what was transacting pre-COVID.
I mean, you feed that into your own transactions. Who are you seeing? Who are you predominantly selling to, and who are you predominantly buying from?
So it's a mix. On the buy side, it's always a mix for us of other lessors, typically the larger lessors who do have order books and or direct with, sale-leaseback transactions with airlines. On the sell side, it's been a reasonably consistent set of people who sort of specialize their investment thesis in that last, that last realm of an asset's useful life. And so on average, the things we've been selling in the last few years are 15 or 16 years old. And so, the folks who are interested in taking that asset, kind of grinding out the remaining life and lease term, and in a sense, most of them parting out at the end of those stub leases, those assets into the market in a place where they've sort of developed their expertise and want to focus their energies.
And maybe, Mike, if we move to the liability side of the balance sheet, obviously you guys have the ability to tap the unsecured bond market. Can you talk to me around what debt products you're most availing of? And then we might talk to your overall perspective on the aviation debt market.
Yeah, so for us, as you mentioned, we've been an active player in the unsecured market since 2010, when we did our first issuance as a high yield credit. We got upgraded in 2018 to investment grade, and so that is the predominant source of debt capital for us. Clearly, coming out of COVID, as the rates in the capital markets were still high, we saw an opportunity in 2022 to do some secured debt with a number of our aviation bank partners who are part of our revolving credit facility structure that we have in place at more attractive terms than were at that time available in the unsecured market. Since then, we've been back to the unsecured market, I believe, 3 times in 2023, 2024. at successively lower coupons, if you will, driven, of course, by not just the base rate, but also the credit spreads have come in pretty significantly for lessors in the context of what's happening in the capital markets overall. In addition, we've done some JOLCO financings, particularly on some of our E2s with KLM. And so that's another form of financing at from our perspective, attractive interest rates. But it's an asset with a long-term financing that effectively you're making a decision that you're going to hold for a long period of time. So it's not the most conducive to a company that's trading minded, but it does fit in the context of using some of that capacity to help drive down our overall cost of funding.
Bringing you back to that spread point for a moment. So spreads tightening, obviously a significant positive for you guys. What is driving that, or what do you think is the key? Is it overall market conditions? Is it maybe a more favourable outlook on the leasing sector itself? What do you think is bringing in the spreads?
I think it's kind of an overall market perspective largely, but I think it's also, investors throughout COVID and, both the investors and the rating agencies have come to realize the resilience of the leasing model and the amount of pain we took and all could withstand and have been now kind of moving forward and are all in the process of dealing with some of the restructurings and COVID hangover that still exist in everyone's portfolios. But I think as an industry, we've done it in a pretty remarkable way. And I think that resilience has been rewarded by the investor base, who've become more educated over time, and I think also has broadened out over time, as we've seen in our last few issuances, a lot of new names taking meaningful interest in aviation bonds.
And maybe to bring in two other elements on the debt side, before I would mind coming back to the investor piece, maybe on the equity element, your thoughts around maybe the alternative lending market and whether or not, like, I think if you can tap the unsecured market, it's one you're probably unlikely to play in from a cost perspective. But it seems to be playing an increasing role in the sector when we look at these private equity, typically backed equity, debt lenders. Your thoughts on whether that will be just a niche product that's attractive to certain types of asset managers and lessors, or you think it's something that might become a bit more mainstream?
I think ultimately it feels like it's heading to be more mainstream. I think the banking industry by and large is becoming more regulated over time, and aviation lending is not the simplest or cheapest, sort of cost of capital allocation from a banking perspective. And you combine that with kind of the ESG aspects of aviation, I think it will be a challenge for banks, sort of going forward. And I think the alternative lenders, private credit filling in, whether it's the Apollos or the Ashlands or Volafins, there's a lot of players, and I think there's a lot of demand, and I think that there will be growing supply of private credit to support the aviation business, because I think the amount of money you can deploy is significant given the capital intensity of this industry. And most of the private equity firms who pick a sector to play in want to do it in a place where they can deploy significant amounts of capital in a reasonably quick period of time and generate the returns commensurate with the risk that they think they're taking.
And then another element on the debt side is probably the ABS market. And I know, again, one that whether that's the rates you can achieve or just the cost of putting the structure in place, it's probably not a for Aircastle, not putting the words in your mouth, right? But the element then around how important you think it is for the overall sector. Sometimes I do wonder, do we spend too much time talking about ABS, even at its height, it's funding maybe $9 or $10 billion of assets, but just how important do you think it really is to aviation finance, and what's your outlook on that market looking into next year?
Yeah, look, I think it's an important sector of, the debt markets available for aviation. Clearly, as it shut down during COVID and as it's beginning to reopen, many of the folks who use ABS as a financing source in their pursuits in the business were using warehouse facilities from aviation banks or others to compile portfolios that they could turn into an ABS financing. So the reemergence of the ABS market, takes some of the pressure off those warehouse providers who were typically in these things longer than they were originally hoping. So it creates some additional liquidity, which I think is good by and large, for a capital-intensive industry. Sometimes it maybe creates competition for people who I might be chasing assets against, that they now feel better about their financing optionality. But I think a whole across the industry, I think having a healthy ABS sector is kind of beneficial for everybody.
And maybe moving on to the equity investor side, pick on a couple of threads you mentioned around, one, the overall resilience of the sector being as strong as it was, and that's in the face of probably an outsized COVID impact, an outside Russian impact. And you mentioned the probably increase in the number of debt providers that are interested in taking your debt products. Do you see something similar on the equity side? Now, I know that was something you maybe had a greater picture on when you guys were a listed enterprise. But do you think aviation finance or aviation as an asset class is more or less attractive than maybe where we sat in 2019?
I think it still is an attractive asset class. I think it's a question of, from an investor's perspective, obviously they have a much broader palette of what they can do with their funds. But I think aviation has proven to be resilient, have reasonably consistent return profile, and it's a long-lived asset, and it's a sector where lots and lots of money is required. So I think that makes it attractive to investors. As a public equity, aviation listed companies haven't performed that well in terms of a trading perspective. But there's many large private equity owners of aviation. Our two shareholders, Marubeni Corporation and Mizuho Leasing of Japan, they like the sector, they like the long-term fundamentals, and they have the ability to be patient and continue to deploy capital, in a way that they see fit to help grow the business over time. So I think it still remains a very attractive sector, and I think it'll continue to attract new capital. As some people decide to go to other things, it seems like there's always a flow in of new players looking to fill those gaps and invest in the aviation space.
And as you assess the nature of those players, I mean, you referenced Japan, which you're obviously very familiar with, and has a long and storied history of investing into aviation. We've seen, China come at the space, maybe regress a little bit over the last couple of years, and private equity constantly circle in. Do you think there's other interesting trends that might develop in relation to the nature of the investors coming at the space?
I'm not sure it's that different, but I think you might be seeing different sort of sovereign wealth funds or pension schemes who are investing dollars in aviation from different parts of the world. Clearly, the Saudis have made a big splash in starting Lease and investing there. They're supporting airlines in their country. You've seen the two big funds out of Singapore, GIC and Temasek, have been in and out of aviation in different forms over time. And so I think you'll continue to see more of those big sort of schemes looking to have exposure to aviation investments, whether it's equity and or debt.
And maybe looking at the macro environment for leasing, I'm going to talk about this a little bit a year ago, right? The importance of scale and maybe the importance as well of being investment grade. And Aircastle's interesting because I'd say a lot of the investment grade lessors are not playing predominantly in that secondary space.
Correct.
So one, you kind of feel that's a competitive advantage for you guys as you look at the market. But two, do you think we will end up in a world where we just have a fewer number of very, very large lessors, the ones that can play in narrow body new tech, and everyone else is kind of playing in the secondary or niche field?
Yeah, and it almost feels like we've been heading in that direction, and it's developing. As we kind of think about the landscape, given our strategy and our funding, we look at the big lessors as, in essence, competitors for capital. So I'm not often competing with AirCap or Air Lease or SMBC or BOC to find new investments. I'm typically buying from those folks. But when I'm raising money, in essence, we're being benchmarked against them, and we have a spread differential to all of them. And I think that's largely driven by our scale compared to them, as well as the ratings differential, because our portfolio is a little older than most of them. And that's a bugaboo for the rating agencies, age of portfolio. And then on the investing side, we're typically more typically competing with people who are not investment grade rated, who use different funding sources, whether it's private equity, private credit, bank debt, et cetera. So the competitive dimension is different on the capital side versus the asset side typically for us.
But do you think then, if that's where we're moving towards at that bigger level, will we see any uptick around consolidation? We've always had some levels of consolidation over the last, maybe 3 or 4 years. It's been that leasing platform with 100 to 150 aircraft. You think the likes of AMCK or Goshawk or the Standard Charter book. Is that kind of where you see that consolidation happening? Or could you also see it maybe in the areas you're competing with that, someone in the secondary space, I really need to get some scale around the secondary level to try and actively play in this space?
I think you'll see a little bit in both places. Is my expectation.
And maybe to pick up on a point then, Mike, that you mentioned, and it's funny when we chat about ESG, right? Saying to someone, I'm nearly bored talking about it because I'm not sure there's anything new to say around aviation. You referenced earlier the piece that I think is coming down the line, right? Which is banking regulations effectively tightening us in, tightening into what they'll be willing to fund, which then narrows the market a bit. Taking maybe that regulatory element of banks aside, do you see it impacting on the near term on other debt and equity investors, the ESG agenda?
It doesn't feel like it's a material consideration. I mean, clearly there's still some folks doing some sustainability-linked bonds or debt products that you see from time to time. I don't think it's at the level we might have guessed 3 years ago. But I think it's always going to be there, but it feels like the timetable and everything seems to be sort of shifting to the right as it relates to that. Because again, in aviation, there's no solution. There's a transition to newer tech, which is, again, more fuel efficient. There's the development of SAF, which most people believe is going to be a significant contributor to aviation meeting its targets over the next 2 to 3 decades, but we have a long way to go on that front. But in the meantime, I think you need to be conscious of it. And from our perspective, the most meaningful place where we're focused is our investments. And investing in assets as the market's developing means investing in new tech and prior tech. But in time, as the market shifts to NEOs and MAXs, the NGs and CEOs will disappear, just like prior generations have. And we're just looking to follow the market and make sure we're funding the assets that our customers are looking for.
Yeah, and yet you might wonder as well, the way geopolitical events have developed over the last few weeks, whether that climate change agenda is probably going to be slightly more on the back foot than it potentially would have been. But we'll see on that front.
Feels that way. Time will tell.
Just in closing, Mike, and thanks as always for the time and the insights. As we sit here in late November and we look out into 2025, what are your optimism levels like?
We feel pretty optimistic about the market, the supply. As I said, supply issues will persist for a while, which leads to a good demand environment. We're comfortable operating in a more challenging investment environment and taking our time and remaining disciplined about how we grow our business. We have plenty of capital now that our shareholders have completed their equity investment in Aircastle. We have substantial liquidity in our revolving facilities. And so we think we have the ability to grow, and we're going to continue to maintain discipline to find the right assets and at the same time continue to sell, both to obviously materialize gains from our portfolio, but also to give us the opportunity to recycle capital and fuel that growth going forward.
Well, Mike, on that optimistic note, thanks again on behalf of KPMG and Airline Economics for your time and insights. Congratulations to Aircastle again on your 20-year milestone, and I wish you guys a very successful 2025.
Thank you very much. It's a pleasure to be here.